In this lesson, understanding currencies, the learning objectives are: you should understand currency codes, you should know what the major currencies are, you should know what the commodity currencies are, you should know what a currency pair is, and you should know what the three categories of currency pairs are. ISO 4217 Currency Codes is a standard published by the International Organization for Standardization that defines how currency symbols are represented. But that's not important. What's important is that you understand what it represents. Looking at this example, USD, the first two letters identify the name of the country. For USD, it is the USA, which is the first two, so USA. And then the third letter identifies the name of the country's currency. This is usually the first letter of the currency's name, in this case, the dollar. In cases where the currency is independent of the nation, the country is listed as X. For example, the code for the Eastern Caribbean dollars is XCD. It needs to have two letters for the country, so it has X and C. X to represent it is independent of the country, and C for Caribbean. The D is for dollars because it is the name of the currency. X can also be used for special situations, like the exchange rate for gold, which is XAU. The major currencies are stated below along with their country and their code. You can pause here if you need to make notes. The currencies most people trade are the majors. The majors make up approximately 85% of the foreign exchange market. The three major currencies at the bottom were commodity currencies, and they were in red. They were the Canadian dollar, the Australian dollar, and the New Zealand dollar. A commodity currency is a name given to currencies that move with the prices of commodity products, due to the country's heavy dependency on the export of raw materials for income. The Canadian dollar moves with the price of oil. This is because Canada is a very large producer of oil, and when the oil prices are higher, they can make more money, which is better for the economy in Canada, which improves the price of the Canadian dollar. The Australian dollar and the New Zealand dollar will react to movements in the price of gold because they are very large exporters of gold, and the idea, like the Canadian dollar, is because when the price of gold goes up, they can sell it for more, so more money flows into the economy, better for both of these countries. This is what a currency pair looks like. GBP, the Great British Pound, / USD. A currency pair is a pair of currencies, where one currency, the Great British Pound, is quoted in relation to another currency. The exchange rate, which is at the moment 1.37, is the relative price of two currencies. But what does this mean? Well, it means that £1 will get you 1.37, maybe that's $7, $1.37 for every £1 you convert. There are three categories of currency pairs: the majors, the crosses, and the exotics. These are the major currencies. If you have been paying attention, you would notice immediately that These are all the major currencies paired with the US dollar, because the major currencies always include the US dollar. These major currency pairs are the most liquid in the world. But what does liquidity mean? Well, it's used to describe the level of activity in the financial market. The liquidity is based on the number of active traders buying and selling a specific currency pair and the volume being traded. So when, let's say, the pound to the US dollar is being bought and sold a lot, it is said to be very liquid. The more frequently traded something is, the higher its liquidity. The word liquidity is very important in Forex, and we'll come back to it again and again in future lessons. Cross-currency pairs do not include the US dollar. Crosses that involve any of the major currencies are also known as minors. Crosses are not as liquid as the majors, but they are still very liquid nonetheless, especially the minors. Just to make it a little bit easier to process, the reason why I keep mentioning liquidity is because liquidity reduces the costs that you have to pay when you trade. This is a little bit of an oversimplification, but we will come back to this in another lesson. Here is a list of Forex exotic currency pairs. Exotic currency pairs consist of one major currency and one currency from an emerging market, such as Brazil, Mexico, Chile, Turkey, or Hungary. These pairs are thinly traded with bigger transaction costs and are not widely used in global financial transactions. Trading exotic currency pairs is considered to be riskier than trading the majors or cross-currency pairs, as price movements can be very choppy, meaning they fluctuate wildly due to the lower liquidity. Due to the overall lower degree of liquidity, exotic currency pairs tend to be far more sensitive to political, economic, and social events. Picking the right currency pairs to trade depends on your experience as a forex trader. If you're new to the game, it's best to stick with the major and minor pairs. It's easier to find trades and you'll get lower spreads. Exotic pairs are more difficult to work with because they're far less liquid and you will have to pay higher transaction costs.